Market opens, you rush to check your portfolio, and one of your biggest positions is down 7% on no news. Your stomach drops, you start scrolling on Reddit or X looking for some reason that this price action is happening. This happens to pretty much every investor, including myself, who buys individual companies. This is just the human way of handling the emotions of money in the stock market. And this creates an emotional gap. The difference between buying a stock because it sounds like a good idea and knowing why you bought that company. In markets like the one we're in today that are driven by so much fear and volatility and risk, the only way for your portfolio to survive is to have an investment thesis for your holdings. Now, an investment thesis is like a written contract with your future self. It explains exactly why you own that company. So when red days come, and red days always come for every company, you know whether you should stay the course or it's time to sell. So today, I like to go over how to build that thesis and roadmap. A thesis is simply a written argument for why a business will be worth more in the future than it is right now. It's the difference between gambling on price and investing in business. Now let's take Uber, for example, a company that I have in my portfolio. Now, whether it's true or not, your thesis shouldn't be, I like to use the Uber app. That might be true. It might be a reason why you want to invest in the company, but that's not a thesis. So instead, let's build one for Uber. The first part is an elevator pitch. Essentially, it's in 2 to 3 sentences summing up why you're investing in that company. What does the company do, and why can't another company just come along and steal their lunch? Is it a toll bridge? Does this company have network effects? Is it a strong brand? If you can't explain in a couple sentences to someone who doesn't know anything about the company why you believe in that company, then you don't know enough to invest. Then we want to see if that story we have matches the numbers. This is where we'll look at revenue statements, earning reports, and financial metrics over time. We're looking for things like, is their top line moving? Which means, is the revenue of that company growing? Is it growing over time? How about things like free cash flow? We also might want to look at the earnings that a company has and how that's growing over time. If it's a dividend growth company, we'll also want to look at the dividend metrics. What's that CAGR? What's the payout ratio? And how sustainable is that dividend? You want to make sure the numbers match up with the business model and moat and set up for sustained growth over the next 3, 5, 10 years and beyond. We're looking for history of performance, history of growth, and indicators that that growth can continue into the future. Now, once you identify a great company with great numbers, you still have to get that company at a good price. Even a great company is a bad investment if you pay too much for that stock. This is where you'll want to do some valuation analysis, and there's a couple different ways to do this. One thing I like to do is look at PE ratios. What have those looked like historically? How does that compare to the growth of the company that I expect? And what does that look like moving forward? You have to be able to tell yourself that I'm buying this company because I believe it's worth a higher price than I am paying today. Another tool that can kind of be helpful as a confirmation thing, I wouldn't rely on it entirely, but you can look at analyst forecasts as well. You can see here for Uber, we have a consensus price target of $107, about 50% upside. I would never rely on this entirely, but it can be kind of a helpful confirmation tool when you're running your analysis. You can also run different types of analysis, like a discounted cash flow or reverse DCF analysis. Basically, you're running these analysis to see if the company is mispriced compared to the growth that you'd expect. When I run Uber, I'm expecting about 15% free cash flow growth year over year moving forward. And that gives me a fair market value price of $115. Running this type of analysis just lets you know if a stock is mispriced compared to the kind of growth estimates that you expect moving forward. And lastly, one of the most important parts of any thesis is to build the bear case. What makes you and your thesis wrong? If you can't think of 3 reasons why you might be wrong, you just haven't done enough research to be invested in that company. Uber is one of those companies that has a lot of bear cases, and that's one of the reasons I believe the stock price is so disjointed from the fair market value of the company. But again, if you can't identify a true bear case for that company, you probably don't know that company. Okay, so now you are ready to build a thesis. Where do you get that information? There's tons of resources online, but one of the best is the company's investor relations webpage. These pages are great. They give you detailed financial statements and reports, but they also give you lots of updates about what the company's working on, new partnerships, acquisitions, and other things going on with the business. However, don't just look at the headlines, look at the earning report, get into the nitty-gritty. Read about what their guidance is, read the blurbs from the CEO about how they expect the next 6, 12, 24 months to look like. Read these highlights about the metrics, but then get into the metrics themselves. Look at these numbers, look how they compare, look how they've changed, and look how the company is positioned to move forward. Another thing that can be helpful is to listen to earning calls. This gets you direct messaging from the CEO about what they believe in the company. Are they confident in the company moving forward? Are they just making excuses for the company? And it's a good way to kind of build that qualitative analysis and that elevator pitch part of your thesis. Once you've done all this research and once you've done all the analysis of the fundamentals, the next step is to actually put that pen to paper and write the thesis. Now, this isn't my exact Uber thesis because I keep my thesis along with some fundamental metrics in a paper journal. But you can open a Word doc or a Google Sheet or pretty much any way that you want to track your thesis for each of your individual investments. So I have here pretty much my thesis for Uber. I am buying Uber because they dominate the rideshare market and are diversified into international markets and other revenue sources such as subscriptions and delivery. The current price is attractive because the market is overreacting to the threat of autonomous vehicles. I will sell if the user base starts to decline. So I have a paragraph very similar to this in my journal. And I also have some of the key metrics, some price targets. Like I said, the analyst price targets are about $107. I have my fair market value for Uber at about $115. And so I have a price target of, I'll buy anything under $90 for Uber right now. That gives me that little bit of margin of safety for buying because again, Uber is a riskier company, but it's one of the companies that I truly believe in moving forward. Now, when you're building a thesis for a company, it's not just a set it and forget it kind of thing. A thesis is a living document, and you have to make sure you're keeping it up to date. I like to, every quarter, just do kind of a 15-minute quick check-in. I'll read through the earnings report, read through the guidance. I'm looking for, did the moat of the company get stronger? Are the numbers staying about what I expected? If it's a dividend company, did they raise the dividend what I expected? I'm just making sure that the company is still on track with that thesis. If the stock drops 20%, but your thesis is 100% intact, congratulations, the stock is now on sale. This is the time that you should be buying. But if the price stays the same, but the thesis breaks, whether that be a change in the business model or a change in some sort of valuation, that's when you consider walking away from the company. Now, not only does a thesis statement help you when stocks are on their lows and help you from being fearful and selling out of panic, but it helps you learn when you should sell your companies. I'm invested in Uber because I believe they're the number one platform for rideshare and the number one platform for delivery. And if their user base starts to decline, that's when something starts to change in my thesis. And that's when I might want to reconsider my investment in Uber. Now, investing, it's a marathon, not a sprint, especially for us younger, longer-term investors. Now, writing a thesis might take an extra hour of work, but it saves you from succumbing to fear and from making rash decisions with your holdings down the road. This type of thesis only works for certain types of holdings. For example, I build my portfolio around core ETF holdings, and those go through a slightly different analysis process. But I still build that same long-term thesis about why I believe in that holding in the long term. When I invest in individual stocks, I want to make sure that I'm extra selective. Limiting my holdings to around 15 in total, that's about the number that I like. That allows me to monitor earnings, updates, I can watch headlines, and I can ensure that my thesis for each holding continues to support its spot in my portfolio. Now, if this video helped you to think a little bit more like a business owner and a long-time investor and a little bit less like a gambler, please hit that like button and subscribe and learn a lot more about long-term investing strategies. We'll see you in the next video.